I think we're ready to go, everyone. We have a very large audience on the line, so I want to get started here and be efficient with our time. I value everyone's time, so we've asked all the presenters and the people that are involved in coordinating this to be punctual, so you can expect that this schedule will be followed quite closely. So welcome, everyone, to our Opportunities in International Energy hosted by Echelon Capital Markets. We have a wonderful cross-section of companies here with assets globally. It's an international focus, and this conference is disguised essentially as our top picks conference. These are names that we've worked with very closely over short and long periods of time. These are stories that we know well, stories that our clients, our institutional clients, as well as our retail clients own in abundance. And they've been very successful. And we're here today to listen to each one of these stories present and do a little bit of Q&A. So we appreciate all the questions that have been sent in. We are going to be joined by Adam Gill. Adam Gill is going to moderate the conference. He is our newest addition to the energy research group here at Echelon. He has over 10 years experience at CIBC, but also some experience at some independents. He knows the energy space extremely well, both domestically and internationally. Today, of course, is the international spotlight. So with that, I'm going to hand it over to Adam. Adam, over to you.
Okay, great. Thanks, Simon. Good day, everyone. Glad to be hosting this international conference for Echelon. We got a great slate of E&Ps for you guys to delve into. First up is Tag Oil. Tag Oil is a Egypt-focused producer. Currently has the VED-1 concession in the Western Desert of Egypt. Presenting from the company will be Toby Pierce, CEO. Toby comes with a wide variety of experience, both on the corporate side and on the capital markets side. And with that, I will pass it over to Toby. Just before Toby starts, though, please note, any questions to be asked, please ask them in the Q&A chat. I will address those questions towards the last 10 minutes of each presentation. And with that, Toby, take it away.
Thanks, Adam. Thanks, Simon, and thanks to Echelon for having us present today. So, excuse the attire. I happen to be in Greece at the moment, but so an international location for an international conference. But I'm sure many of you have seen the Tag Oil story or heard the Tag Oil story. There's a lot of history on our webpage, etc. I really want to highlight a couple things though about the company. So Abhi Badwi joined us in 2020, September 2020. He brought along Sunil Gupta and a couple of new board members. Took us nearly 18 months to get our license in the Western Desert underway. That was awarded in October of 2022. And Abhi was instrumental in helping us get that. He speaks Arab fluently. He's had a number of roles in the Middle East, which I'll touch on in a moment, and has been, he's actually in Egypt right now and has been very focused on helping us get our concessions and the concessions sorted out. Sunil Gupta, formerly of Bankers Petroleum, he was the CEO at the end there after they sold the Chinese. Extremely good from an operations standpoint. And we've witnessed that firsthand in the field. The bed 1 of 7 well that we just recompleted went off without a hitch. The frac itself was as close to textbook as we could hope. Everything else in Egypt has not necessarily been, but we'll get to that in a few minutes as well. Rounding out the board, many of you probably know Keith Hill. He's on the board he's part of the Lundin Group, has been on our board the longest probably now, nearly 10 years. And then Gavin Wilson represents our largest shareholder, Meridian Capital. Meridian Capital owns around 19.9%. Management and insiders on top of that own another 13.5% on top of that. So the background of TAG and why we're excited specifically to have Abhi and his track record. He's had 2 very successful exits in Egypt, Raleigh Energy, albeit that's a while back now. The assets are still performing quite nicely, believe it or not. Managed to return 730% to shareholders in about an 18-month period. That's where he initially made his core relationships in Egypt. Fast forward to just recently, he came off a company called Kuwait Energy. Kuwait was private. They sold that in 2019, however, to the Chinese group UEG, and about an 800 million US exit. And the key behind that is Abbey was able to rekindle all of his relationships with the government, with the ministry, with EGBC, and really understand how modern Egypt worked. So it's been very, very good for us in that regard. We recently just put out a press release. We've just strengthened our team. We added a gentleman by the name of Sabir Abadi. He's formerly EGPC. He was the vice president of production of EGPC. He was the chairman of HALDA, which is the joint venture between Apache and EGPC. And he is also the chairman of EDC Drilling, so Egyptian Drilling Company. So very, very strong track record credentials. And he's been very good at helping us in Egypt navigate the system. So just a snapshot of where we're at the moment. We have it in and around 18 million Canadian on the balance sheet at the moment. We do have New Zealand royalties. They pay us about $1 million US per year. Our Australian partners that we sold our assets to have just drilled a big well in actually two big wells in the Strat Basin in eastern Queensland. Both have significant gas shows and looks quite interesting. So we'll be watching that one closely. But our main concession is the Bed 1 field that we were awarded in October, and RPS has given us over 500 million barrels of oil in place on that concession. There'll be more details to come on that. Cap table, fairly self-evident. The slide, the share price chart has been holding up well. I believe once we start putting out more news flow related to the horizontal well, which is upcoming, we should see that share price continue to perform well. So Egypt in particular is actually quite a good country to do business in. We've been able to move in and hit the ground running. It took a while to get our concessions. The two big negatives, I guess, if you will, about Egypt, it can take a while to get paid in US dollars if you're owed a significant amount of oil sales. That seems to be okay at the moment, although from time to time those payables that EGPC owes you can be a factor. As TAG starting out, we don't anticipate that's going to be too big a deal. Our revenues are quite small relative. We can take Egyptian pounds and spend that money on our in-country staff, etc. The other big difficulty with Egypt is it can be very, very bureaucratic and extremely difficult to navigate. Although with the hire of Samir Abadi, the country manager Gamal Resk, and with Abbey, we feel we have the tools in place to mitigate that. They are very, very pro-oil, very pro-development. Egypt is importing over 300,000 barrels a day of liquids for their own consumption and are desperate for more hydrocarbons. When we were drilling or recompleting our vertical well, the minister's office was getting daily updates. They think it's that important for them to understand what we're up to in the Western Desert. So this is the well we recompleted just recently. Everyone's waiting for the results of the flow test. We should be putting out a press release on Monday morning. There have been a few operational hiccups, a couple sandstorms where we've had to shut the well in, etc. But we'll have over 30 days of test data. The well initially came on at approximately 150 barrels a day of natural flow, and we took the opportunity to put a pump in the hole. We've been pumping that well now fairly stably now for just over 2 weeks, but on and off for over 30 days of production period. We will have oil sales for April. We will have oil sales for May. We're tied right into the plant and are selling oil now. In particular, not much else to really note on the slide, but you can see the thick hydrocolumn section there on the logs, and that's what we were targeting. The Abro Shaft is the source rock for the Western Desert. It's approximately 150 miles by 45 miles in height, and ranges from 30 to 60 meters in depth, in thickness. And that it's very analogous to the Eagle and it's of significant interest to the Egyptian government and ourselves. So this slide highlights our concession on the right. We've got extremely good well control. We knew the oil was there. Over 45 wells have penetrated the Abro Shaft on our concession. 70 wells in the vicinity, very good seismic, logs. We had some core as well. You can see where our concession is located. It's right in the heart of the Western Desert. Apache and Chiron are immediately to the north of us. There are adjacent concessions that are open. We are actively trying to acquire those open acreage positions and are very much working with the government and the ministry to try and lock those up. We have had many different discussions with other industry partners as well. I believe that the Apache and crew will be taking more of a wait and see approach, but we are doing our best to see if we can't lock down some more acreage in the near term. So we're in and around the fourth bubble. We are doing all our planning right now, logistics for our upcoming horizontal well. We're basically on track with that well, and we should have activity here in July on the well. So we're building the site at the moment, and we should be in a very good position here to deliver very, very shortly. So this is the overall bed 1 of 7. The well actually, the frac itself performed extremely well. The flowback was very, very good. Initially, we had approximately 40% frac fluid come back. We pumped just over 110 tons of sand and 2 different sizes of proppant. Almost 5,000 barrels of slick water, and it's exactly what they're using in the Eagle Ford. And while it's not very big in North American standards, it was significant in Egyptian standards, and it was the largest frac pumped in the Western Desert thus far. Our horizontal, we will pump significantly more, over anywhere from 15 to 20 stages at this juncture. So lots of words on this slide, but basically what we're trying to achieve, RPS gave us 530 million barrels of oil in place, with over 430 million US of reserves value unrisked if we can unlock the 20 locations that are in our field development plan. Now, we submitted only 20 well locations to the government. We have a 20-year concession life, 10 years plus a 10-year extension. And the goal was to really keep our work commitments low, achievable. If oil prices, God forbid, went significantly lower, it would put us in a position where we could meet our commitments. We anticipate drilling this up fairly quickly. We see anywhere from 40 to 60 locations on our concession as we speak. That may change, that may grow over time as we do more work, especially on the southern part of the concession and the deeper parts of the concession as well. So really what got us excited about the Abro Shaft and the possibilities here is it's very analogous to the Eagle Ford. It's probably 80 to 90% equivalent to the Eagle Ford. Same deep positional environment, same rough age, permeabilities and porosities are quite similar, same depth of emplacement. The pressure is a little bit higher at Abro Shaft, in the Western Desert. The water saturation is a little bit lower, so those are both more beneficial. But our oil is somewhat heavier, so that's seen as a slight negative overall. So This is what in particular has got Egypt very excited about what we're doing. The Eagle Ford's producing over 1 million barrels a day right now of liquids. It peaked at 1.8 million barrels of liquids, albeit from there's over 26,000 wellbores now in the Eagle Ford, so significantly further along than Egypt and the Abro Shaft. But directionally, that's what people are excited about, and the government of Egypt so excited about, along with ourselves. We're very active, specifically in Egypt, trying to acquire additional acreage. Very much focused on the Abro Shaft, and in fact, the entire Abro package as well. There are other unconventional horizons in Egypt. The Apollonia, which is very similar to the Austin Chalk, and the Homeland, it's called. We are quite far along in discussions with various government entities about picking up additional acreage. Timing on that, it's Egypt, so it could be anywhere from a month to several months down the road. But we feel by the end of the year we'll be successful on at least one acquisition. We are looking at select areas outside Egypt, albeit only one or two countries. In Oman, in particular, there's a bid round currently. We are looking at the data and evaluating. Our focus is very much exploitation. Sunil and his team have done a great job in the past of unlocking more difficult reservoirs where the oil is there. Experts at polymer floods, water floods, etc. So that's the focus going forward, and that's where we'll take most of our time and spend that. What I'm so excited about it right now is the way the well is performing. The Abro Shaft has met all of our engineering expectations, our production expectations. Everyone in the field is extremely excited. I don't have much to go on. I don't have much Eagle Ford experience, but the experts we employed out of the Eagle Ford are quite excited. Our FracMod team are over the moon. This went exactly to plan, exactly what they understood. So I have to give the team credit. They did a great job. So everyone's looking forward now, of course, to production results, which will come on Monday, as I suggested, and then also to the horizontal well. And we should have results from that horizontal end of September, early October, inshallah, as they say in Egypt. There are always delays. One interesting anecdote recently, basically Schlumberger told us to lock down all of our services because Saudi Arabia is sucking up all the service provider content in the Middle East right now. They just contracted 17 offshore rigs and are making a huge push. So it's going to be busy and services will be tight, but done a great job so far of locking down everything we need, and we've been importing stuff from Canada as needed.
Thanks, Toby. Maybe we'll stay on that services access issue, because I think that's an important issue to address. You guys are out there doing some of the bigger fracs in the country. How much lead time do you have in terms of you've locked up your services? Are you settled for and equipped for the next 2 years, 3 years of development, or is it more on a bit of a one-off basis, and then you just got to get back in the queue and get lined up for the next drill and frac?
It's more of a one-off basis, although we have secured the sand from a local sand mine. The guys have gone out and secured that sand for all of our future needs going forward, at least as we anticipate right now. If we do ramp up to 2, 3, 4 rigs for a development phase, we probably will need to source more sand. There's already the drill steel and casing, etc. Bits, all that sort of stuff is quite available now. There was a real shortage. The supply end of things has definitely caught up. The slowdown in drilling onshore US is helping us. We can import steel and parts, etc., from from Houston, from Canada, and of course, we're also sourcing equipment from China.
Yeah, great. And maybe a question in the chat related to that. We've seen the success of horizontal multilateral wells not being fracked in Western Canada. Obviously, the Clearwater is the biggest example, but we're seeing that applied to some more heavy and medium oil plays, and even some lighter oil plays like the Bakken. Any thoughts on attempting a multilateral and skipping the frack in the reservoir?
Yeah, no, that's the guys have looked at that scenario. There is a scenario whereby we drill the well, we drill it horizontal. That's the T100, it's called, our next horizontal. Be about 1,000-meter lateral. It's highly dependent on the fracture networks it intersects. We may choose to produce it without fracking it to start, just to see what it'll do, just to get some verification on what those natural fractures will give us. But ultimately, we want to frack the first couple wells and see what will happen. There is a well, not on our acreage, unfortunately, but to the north that tested over 3,000 barrels a day, and it was never fracked. It was just horizontally drilled by Apache, probably about 10 years ago now.
Great. Maybe just moving on to the marketing aspect of the business. How is the oil moved from the field? What is the benchmark that it's sold at, and what kind of impacts the differentials to some of the key benchmarks like Brent?
Sure. So it's priced off Brent. EGPC aggregates all the oil from the Western Desert. Ourselves, Apache, EGPC's oil, just over 300,000 barrels, and then sells that on behalf of the entire group. Right now, it's Brent minus 50 cents is what they're getting, but it has ranged anywhere from Brent minus $4 to Brent plus $2, depending on the needs and the pricing that EGPC can get. Our oil is evacuated through a pipeline. It was built by Shell, so we get access to the facilities that were built by Shell in the 80s. There's about 20,000 barrels of capacity, about 15,000 barrels a day of spare capacity, and then a pipeline directly to the Alhambra oil terminal. So for the time being, all of our production is taken care of through that network.
Okay, great. Just in terms of development, we got one in the chat, and I kind of had the same question. But essentially, you have a 20 well commitment. How long to drill out that commitment?
Ideally, so once we have a better understanding of the horizontal drill and the productivity, the logistics, and the whole 9 yards, we anticipate we will go to running at least one rig permanently, and that rig will essentially allow us to drill between 4 and 5 wells per year. We should be able to get through, everything being equal, we should be able to get through those 20 wells in 4 to 5 years.
And then just, you talked about the opportunities outside of the development plan. When are you first going to test some of these other opportunities outside of that 20 well program?
Initially, we'll be very focused on the Abro Shaft, and that's where over 3 years of science, engineering, and a huge amount of work has gone into. We're just starting to get our heads around some of the other zones and asset packages. So very much focused for the first year and a half on the Abro Shaft and the development we have there. We do have potentially some access to additional wellbores. We are negotiating for vertical and horizontal candidates, sidetrack candidates from existing wells that are plugged up and or producing low amounts of oil. We're negotiating with EGPC and the government on that, and we'll see what we can bring about. Ideally, we are recompleting wells and drilling new wells at the same time, just to boost our production, get our cash flow up.
Another question from the chat. Outside of Oman, what other jurisdictions would you look at? Only oil, or would you look at gas opportunities as well?
Yeah, gas is fair game. So only onshore, Middle East, North Africa. Would be very hard pressed to chase anything with an exploration angle. needs to have the molecules in the ground discovered that we know we can exploit. Very focused, outside of Oman, we have done a little bit of preliminary work on Bahrain, but it remains right now. I can't see us going outside of. Never say never. A great opportunity may present itself, but I can't see ourselves going outside Egypt, Oman, or perhaps Bahrain or one of the Gulf states.
Okay, great. Well, that takes us to the bottom of the hour. I'd like to thank Toby for coming in and presenting us today. If you have any questions that haven't been answered from the participants, please feel free to reach out to someone at Echelon, and we can help you get those questions answered. Thanks again, Toby. So next company up is Echo Atlantic. The company has offshore interests in Guyana and in Namibia. The company will be represented today by Gill, President and Chief Executive Officer of the company. He brings a variety of experience in both mining and energy development in the Southern Africa region and South America. So with that, I will pass it on to Gill to tell us about his story.
Good afternoon, everyone. Thank you, Adam. Toby, nice to see you. Great presentation. Hi, Simon. Hi, Ryan. Hi, everyone. Thank you for joining. So, Eco Atlantic. As the headline says, we are seeking to create the most exciting exploration company in the E&P world. Actually, we're no longer seeking to create. I think we managed to create the most exciting exploration company. We are a pure play exploration company with a very defined strategy and business model, and I will walk you through. Everyone, please read the disclaimer. It does not need to prevent you from buying our shares immediately after the presentation. All right. So, in a nutshell, we are a TSX and AIM listed company, around 100 million market cap, 100 million Canadian market cap, with a very strong and supportive shareholders base. Our biggest single shareholder is Africa Oil Corp, which I'm sure you all familiar with. And we have a company by the name of Azinam Holdings, is a Bermuda-based E&P company, also hold around 11% of the company. Fidelity recently acquired 6.5% in the market. We have Canaccord Genuity from London, CIBC, Coronation and Meridian from South Africa, and management and board still hold around 21% of the company. As I said, we're a pure play exploration, and we are focused only on exploration upstream petroleum opportunities in the most prospective, what has been a new frontier, and now it become proven provinces. Our business model is quite unique. We come in early into what we think to be prospective underexplored basins. We take a very large stake of working interest in the blocks that we apply for or directly negotiate with the government. To start with, we de-risk them on our own with our own team and our own financial capabilities, and eventually it's our strategic way to partner with much bigger partners, super majors, big IOCs, in order to help us further explore, and we are relying on their technical expertise and deeper pockets. We have, as I said, we have a very experienced management team and mainly a board, and very strong relations with, on the one hand, local governments, on the other hand, big oil and gas companies. In a nutshell, our board comprised of Keith Hill from Africa Oil, you all know him, Peter Nicol, Toby Pierce, former partner, a very seasoned and reputable banker, UK banker, oil and gas banker, Ellen Friedman, whom you all know from Toronto probably. Colin Kinley is our Chief Operating Officer, again, a Canadian by blood. and we have a certain indigenous Namibian on our board and our CFO. In a nutshell, our portfolio spans in the most, as I said, the most prospective and exciting exploration hotspots of the current world. On the west side of the Atlantic, we have exposure to 2 blocks offshore Guyana. One block is was originated by us, the Windward block, where we now have 15% working interest. We drilled 2 wells there in 2019, 2 discoveries, albeit somewhat heavy and sulfurous, but we have more than 1 billion barrels of oil in place already discovered there. On the Windward block, we are partners with Total, Qatar, and Tullow Oil, and the plan is to move it further next year and drill another well into a lighter oil target. We also have an indirect interest in another block, the Kanji block. Both blocks, Windward and Kanji, are adjacent to the golden strip of Guyana, with the 13 billion barrels that was discovered by Exxon in the past 8 years. The Kanji block partners are, as I said, JHI, where we are a shareholder. It's a private Toronto-based company, as well as ExxonMobil as the operator and Total. Moving to the east side of the Atlantic, in West Africa, Southwest Africa, we have 2 offshore blocks in the Orange Basin in South Africa, very close to the border, on trend with the latest discoveries that were made by Total and Shell in Venus and Graph. And we have 4 offshore blocks in the Wallabies Basin in Namibia. Both Namibia and South Africa Orange Basin have become the focal point of interest for the industry in the past 12 to 15 months since the latest discoveries made there. As I said, the 2 basins offshore West Africa or Southwest Africa that we have are Wallabies and Orange. This is just to give you an idea of the amount of activity that goes on. On the right-hand side, we're talking about the South African area, the Orange Basin. Total Energies, Impact, and Qatar Energy are currently drilling the Venus, the second Venus well. The first one last year was a giant discovery, rumored to have anything between 3 to 10 billion barrels. The single biggest discovery, Sub-Saharan Africa, in the past, I don't know, 2-3 decades. Venus appraisal and Venus flow testing is currently underway. Again, rumors suggest that the reservoir is full of oil, and Total are currently taking their flow testing in order to decide on the next potential development phase. In South Africa, Total have announced that they're going to drill up to 10 wells in block DWOB. DWOB stands for Deepwater Orange Basin. This is the block right adjacent to our block. The light blue block is our block, block 3B4B. Total are spudding a well in March 24, right on the border of our block. And again, as I said, they're planning up to 10 wells. They have 2 rigs in the area for the next 2 years. In the Graph block, Shell, Qatar Energy, and Namco, again, they announced a big discovery last year on Graph. There was another discovery just recently, the Yonker-1 light oil discovery. And for those of you who have read the Upstream magazine yesterday, Shell are currently already contemplating a development plan, and they want to have first oil by 2029, 2030 out of this area of discovery. As I said, 3B4B, and I will show you later, is directly correlated to the Graph and Venus discoveries, same water depth, same trend, same basin, same sediment, etc. In Namibia, we are the second largest acreage holder in Namibia, second only to Namco. We've been active in Namibia since the early beginning of the oil exploration era of Namibia. Since 2009, we started to look around. All the blocks were still open. We decided to focus on the Wallabies Basin, which looked to have the right characteristics for an actual oil window and oil kitchen. And in order to diversify the play within the basin, we took 4 somewhat different blocks. One Chevron license is a shallow water. Cooper license is a mid-range, kind of between 700 to 1.5 kilometers water depth, and the Guy and Tamar licenses are deep water plays. Currently, the focus of the industry, everyone in the industry is now looking for deep water. Namibia and Guy license and Tamar license are both answer this exact criteria. In the Wallabies Basin, we're going to see some deals imminent. There are rumors to have a major or an IOC farming into several blocks there. I wouldn't tell you who, and I wouldn't tell you to which block. And Moore and Prom are currently contemplating 2 wells to start at the end of this year, Q4, right next to our blocks right here. So there will be a lot of activity, not only in the Orange Basin, but also in the Wallabies Basin in Namibia. As I said, second largest acreage holder offshore Namibia, but not only that, we have 85% working interest in each of our blocks, and we are the operators. What that means, and we recently reset the licenses in 2021, so 2 years ago, and the licenses are valid and good until 2031, with a very flexible, I would say, work program. The fact that we have 85% working interest and operator gives us a lot of flexibility in potential farm out. We can offer up to even 60-65% working interest to someone, and operatorship if need so. And that makes it very attractive for big companies that potentially in one deal can become not only an operator, but also a very large working interest holder in 4 blocks comprised of 30,000 square kilometers. So in one deal, you can get a very big stake in the offshore Namibia, especially in the deep water ones. And without disclosing too much, I can tell you that even though that we don't have a formal farm out process on our Namibian blocks, we are getting a lot of inbound interest, and we're currently in somewhat advanced discussions with at least 2 big companies that really like to test the potential of, let's say, test the potential of partnering with us in our Wallabies Basin Namibian blocks. In Guyana, as I said, the older green bulbs are discoveries made by Exxon in Guyana in the past 8 years. The first one was Liza, and then many followed. The 31 discoveries comprised of 13 billion barrels, right on the edge of our block. One discovery, actually Hammerhead, has a small stretch into our block, and we ourselves will drill 2 wells back in 2019 with Total and Tallow, and came up with 2 discoveries of 1 billion barrels of oil in place, 13 to 18 API. Unfortunately, our partner and operator, Tallow Oil, is not a heavy oil kind of a developer or producer. They tried to shy away from it, and they decided at that point not to develop it. However, the discoveries are still under our name, and potentially in the future with a different operator, with a different oil price environment, different development techniques, we might be able to develop at least a bigger field, which is Jethro, that we discovered in 2019. As I said, we are planning to enter into the next renewal period, which starts at the end of this year, and we have 2 years to drill at least 1 well into the lighter oil targets that are in the Cretaceous. And these are the 3 options that we are looking at: Kako, Ayatuk, and Kumaka. These are the three red dots there that correspond directly to the channels that lead to Liza, to Fangtooth, to Skipjack, and others. The joint venture, comprised of Total, Qatar, and Tallow, We'll take a decision before entering into the next renewal period, which target to drill and exactly when. Of course, it was if it was only up to us, we would have drilled it Q1 24, and hopefully the joint venture will take the same decision. Just to give you a perspective about the Orange Basin, Orange Basin is considered to be the last largest delta basin of the world. To give you an idea how big it is, this is the entire Guyana-Suriname stretch of the left-hand side. This is the entire Guyana-Suriname stretch of discoveries. Again, 13 billion barrels in Guyana, additional 3 billion barrels here in Suriname, so 16 billion barrels. And this is to scale to the Orange Basin. So this is the entire Guyana-Suriname basin. You can actually fit it into one block, which is 3B4B, our block in Orange Basin. This is the Orange Basin, a huge delta, came from actually two rivers. This is the Orange River, but there was another river right here back in the days. This is South Africa. This is the border between Namibia and South Africa. This is the entire basin. And we see all the sediments went like this, like this. This is the Kudu gas discovery. This is the Impact and Total Venus 1 discovery. This is Graph 1. And as I said, 3B, 4B, we managed to identify in the latest CPR more than 4 billion barrels of prospective oil on some very, very interesting prospects that look not dissimilar to Graph and Venus. We are lucky to have Africa Oil as our biggest shareholder. Africa Oil has access to the Venus data because they are also the biggest shareholder in Impact. Africa Oil holds 32% of Impact, and therefore they have some access into the data of Venus. We managed to use this information, use this knowledge in order to incorporate it into our own CPR and studies of 3B, 4B. And 3B, 4B looks to be very much analog to what we see in Graph and Venus. We are planning to complete our farm out process, hopefully not too far away in the future. Let me put it this way. We are actively engaged with certain groups in negotiations, and the plan is to spud at least one well out of two, sometimes in the middle of 24. The rig availability in the area is not great, but we have Total with 2 rigs contracted for the next 2 years. They're currently working in Venus, and they will, as I said, they will move down to South Africa to drill the adjacent block in March. And also Shell has 1 rig which is contracted for the area for the next 2 years. So there will be some rig slots. So once we complete, hopefully, our farm out process, we will be able to go ahead and drill. Currently, we are in the middle of the EIA process, which will be followed by a drilling permit process, and we will be drill ready, hopefully by the end of this year, when we finalize a potential farm out and move ahead to drilling next year. In terms of timeline, this was our portfolio. So 6 blocks, West Africa, 2 blocks in Guyana. In South Africa, Block 2B, I forgot to mention Block 2B. This is Block 2B. We have an existing discovery, the AJ1 discovery, with around 38 to 40 million barrels of light oil. Not commercial enough. It's not enough to be commercial. It's too small, 40 million barrels there. However, we drilled another well just last year. Unfortunately, unsuccessfully, we didn't find the commercial hydrocarbons. However, based on the historic discovery that we have on this block, we applied for a production right, and currently we are in the process of granting it a production right. We are currently in discussions with PASA, with the government, with our partners, to see where we're going with that. We believe that the grant of the production right will be given at the end of this year or sometimes next. At the moment, it is just a very interesting real estate to have, giving all the activity in the basin. In 3B, 4B, as I said, the EIA process is in place, and also an official farm out process. We are targeting for 2 exploration wells, Q2, Q3 24. Once we complete the farm out, that will be the plan. By the end of this year, we believe that we will have the EIA approved and the drilling permits given. As I said, there will be rigs in the area, and there will be a well spudding right next to us, next door in the Deepwater Orange Basin block. In Orindwik, as I said, we are refining the Cretaceous targets with Total and Tullow at the moment. The decision to enter into the next exploration phase will come at around October. And once we enter, that means that we are committed to drill at least one well in the next 2 years, so 24, 25. And we hopefully, between us and Total, we will look to drill as soon as practically possible. In Kanji block, we are an indirect interest holder. We don't even have a direct working interest. So we are waiting for Exxon and Total to decide when they're going to drill the next well. They are committed for yet another well, otherwise they need to relinquish. It can be either in 24 or in 25. Again, we have a free exposure to this well after our investment in JHI. We don't need to pay anything, and we will be, and hopefully we will have an exposure to a successful well there. In Namibia, we are currently doing a structural report study and additional G&G. And as I said, not official process, but we have a lot of inbound interest, and we are in discussions with several companies to come and potentially partner with us on our 4 blocks, 85% working interest. In parallel to that, we are quite known to be active, and we don't stand still, and we don't wait for the catalyst to happen. We would like to create catalyst, and we are currently evaluating additional assets with the same kind of profile in the same jurisdictions or same regions that we are operating and familiar with. And we also look for additional corporate opportunities. In our past, we did already 2 mergers, 2 investments into other companies. So we are quite active also corporately, and we are currently looking for additional potential deals in order to grow our portfolio and to grow our potential shareholders' return. That's in a nutshell, as I said, exploration focus, catalyst driven, a lot of great acreage in the hottest spots of the exploration world, listed in Toronto, listed in AIM. I don't know if those of you who followed our historic share price, currently we are traded at 29 cents. There were times we were at more than $3 after a good deal or a good discovery. So the potential is huge. And I believe that the next 18 months will be very, very telling, and will have the potential to transform the company into yet again a very big or a mid-cap company, other than a small-cap company that we are at the moment. That's it.
Great, thanks, Gill. Obviously, very high impact exploration potential. Maybe just starting with some of the farm outs that you're potentially looking at, what kind of structure would be reasonable to see? How much is typically given up to have one of the large producers come in and drill the well?
First of all, it depends on the commercial merits of the deal, obviously. These companies, they don't come for 10% or 20% working interest. They need a significant stake. Anything from 50 to 60%, that's the threshold. It was published already by us and Africa Oil. We are currently discussing 55% working interest to a certain farming that would, in order for him to come and drill 2 wells fully carried, 2 wells with additional payments. So around 55%, as I said, in 3B4, be 50 to 55. In Namibia, as I said, we have 85%. We feel very comfortable at 20, 25. So there's a lot to offer. So in that sense, as I said, the ballpark is around 50 to 60%.
Maybe just highlight strategy with the company. Obviously, you've set up a number of very high impact exploration opportunities in the 3 countries. Is the goal for the company to take production and take its working interest share and become an actual producer, or do you think as development plans, once the exploration is concluded, the development plans come out, should there be success, Do you see yourself as maybe stepping back from the asset, letting the operator take a bigger ownership, taking some cash on hand, and then rolling that into either another project or finding additional opportunities?
That's a great question, Adam. Let me start by saying, listen, I look very bad in helmets, in yellow helmets. I look very bad in general, but in helmets, I look very bad. There's no intention that we will stay on a producing vessel for the next 25 years collecting royalties. This is not the business model. This is not the strategy. One of the reasons we are partnering with big companies is not only to rely on their technical expertise and deep pockets, is in order for them and to take over once we have a proven discovery and a development plan going forward. We have zero competitive advantage in developing offshore, huge offshore field, and we don't have any real experience in producing oil and paying dividends to our shareholders in the next 25 to 30 years. What we do know is to identify a very good project, to bring in the good partners, hopefully to have a big discovery and immediately to monetize it. Let's say we monetize something for, I don't know, $500 million. Probably $490 million out of it will go immediately back to our shareholders, and we only need to keep small money in order to continue the same play. So the goal is to explore, discover, sell on / monetize, and return a lot of money to our shareholders.
Any onshore opportunities in South Africa or Namibia that potentially you would look at?
We feel more comfortable offshore for many reasons. We think that the elephant hunting is offshore. Onshore, given our strategy of explore, discover, and monetize, onshore usually represent a smaller play with different development needs. We don't say no, but we didn't come across the right opportunity to date that will justify entering into onshore. By the way, we started our way in Namibia with 3 offshore blocks and 2 onshore. After a year, we relinquished the 2 onshore ones that were not interesting enough for us. It was coal-based methane and quite a complicated development. So in a nutshell, the focus is offshore.
Okay, understood. All right. Well, with that, thank you, Gill, for the presentation. As I said on the last call, if there's any questions that you want to address as you continue to kind of digest these stories, please reach out to one of your partners at Echelon, and we'll happily address that. Thank you, Gill, for your time.
Thank you very much.
Moving right along, and we had a little intro from Gill. We got Robert Bose from Santana Energy. Santana is also looking at opportunities in Namibia and has interest in Colombia. Obviously, Colombia has been a long-standing international onshore success story for producers listed in the Canadian markets. So with that, I will pass it on to Robert, and we'll dive into Santana.
Thank you. For those of you I don't know, as Adam mentioned, my name is Robert Bose. I'm the president and a director of Santana Energy. And in the first instance, a heartfelt thank you to the whole Echelon team for hosting us all today and allowing the Santana to participate. And we certainly appreciate everybody's time this morning. This afternoon. Next slide, please. I will leave you all to peruse our disclaimer at your leisure, but just to set the table a little bit. Santana is a TSX Venture OTC QB listed oil and gas exploration company that's focused on creating a portfolio of exposure to large resource outcomes with limited additional capital required from us. Not dissimilar to Gill's strategy, we look to identify opportunities early, provide resources, be they technical or financial, to mature early stage opportunities, and then put them into the hands of people that have both the technical capabilities and balance sheets to deliver success. We are very much focused on this from an oil and gas exploration perspective. And as you'll hear about over the next few minutes, we've got a deep bench of strength with a lot of experience in executing transactions like this over a long period of time. So that's kind of the strategy and kind of what we're trying to do. Again, just to set the stage a little bit more, with respect to the cap table, there's 390 million shares outstanding. So roughly on a fully diluted basis, 100 million market cap Canadian. I would note that we ended Q1 with approximately $5 million in cash on the balance sheet. This is more than 3 years of cash G&A. So we've got kind of a long runway, as again, you'll hear about in the next few minutes. Given our current portfolio, we have no capital requirements upcoming, and we are certainly fully funded. I would as well note that in a financing that Echelon was good enough to lead for us in March of last year, we issued approximately 90 million warrants that are struck at 25 cents Canadian. Pleased to report that those are currently in the money. And given the number of exploration catalysts we have between now and then, when they expire in March of next year, we would expect some or all or a material portion of the $22 million Canadian to arrive on the balance sheet by the end of Q1. So certainly fully funded with more capital we expect en route. In terms of major shareholders, Charlestown is a family office in New York. We have been investing in the exploration business for close to a decade. Just as a related matter, we're actually a shareholder, I think, in all of the public companies presenting today. So we're certainly very grateful to all of the management teams for all the progress they're making on their businesses. Centenna sits in a vehicle together with those investments called Charlestown Energy. We became the cornerstone investor in Centenna in 2019 and continue to be extremely excited to provide capital and leadership here. We think it's got a tremendous near-term future. In terms of other relevant shareholders, Grisham is a private entity which is owned by our Namibian partner in a transaction I'll describe for you further in a few moments. He received approximately 34 million shares in Centenna, is one of the largest shareholders of the company. And then insiders, approximately 12%. And then just to unpack a little bit this cryptic major shareholders bucket, this is what I would call friends and family of ours. These are people we regularly invest with who joined us in the financing last year. So between all these constituencies, we are on top of, over 50% of the stock. It's been nice to see the stock react a little bit to some very significant developments in Namibia, generally speaking, in the Orange Basin and in our blocks in particular recently. But we feel like it's still very early days. There's a lot left to do here, and we feel like this remains a tremendously attractive attachment point, a point for the stock. So why invest in Centenna? I mean, just to kind of hit the punchline, Centenna is the only public vehicle that provides exposure to the heart of Namibia's Orange Basin on a carried basis. No one has the combination of positions in licenses with carry that we do. And, as you heard from Gill, it is the hottest exploration geography on the planet. It has the potential to be the world's next great hydrocarbon province. And we really, as you'll see in a few minutes, are located right at the center of the action. We've got multiple catalysts on deck over the next 4 to 6 quarters, any one of which would be a company maker. So many shots on goal, no further capital required from us to get to those finish lines, at least with respect to the existing portfolio. And, as I alluded to earlier, a tremendously experienced management team. I mean, beginning with our local partner in Namibia, Knowledge Kati, Knowledge, in addition to, as I said, being one of the largest shareholders of the company, a fellow board member and leader of our business in Namibia, has been a longtime entrepreneur there. Knowledge founded an offshore company called UNX, which had a number of licenses. That company was sold to a Brazilian company called HRT. It's $700 million or something like that, and around 2012, 2013. So a very strong track record there. The CEO of Centenna is Doug Manor. He was one of the founders of Cosmos. And, in our longstanding asset in Colombia, demonstrates our ability to originate opportunities early and then bring partners into there. We are partnered in Colombia with Exxon. So as I said, we've had an asset in Colombia. The company has had predecessors going back to kind of the mid-90s, but in 2012, it was significantly reformulated to focus on Colombia, where we had many licenses. Today, we maintain an interest in a single unconventional joint venture, as I said, where we are partnered with Exxon for an unconventional opportunity in the Middle Magdalena Basin. But as a result of a transaction we completed in March of last year, the sort of center of gravity, certainly the locus of value, has swung dramatically to Namibia, and we can talk about that a little bit more here. In Namibia, we maintain, together and through our partnership with Knowledge, exposure to 4 offshore licenses and 1 onshore license. We were introduced to Knowledge in the early summer of 2021, and we were extremely attracted to many things about the opportunity to partner with him. The portfolio that he had, that we ultimately stepped into, provided a level of diversity which we had been sort of thinking hard about, having experienced the realities of very concentrated risk in exploration, single basins, single discoveries, single operators, single countries. We were keen to diversify the platform a little bit, but not change the overall return potential that exploration brings. The portfolio that Knowledge put together provided the diversity that we were looking for. It was diversified onshore and offshore. In the offshore context, in the Walvis Basin, which Gill elegantly described, as well as the Orange Basin. And in the Orange Basin, proximity not only to the only commercial hydrocarbon discovery to date at the time in 2021, the Kudu gas field, but as well to 2 very exciting exploration prospects, which were still events on the horizon when we entered into our agreement with Knowledge, specifically being Venus and Graph. And so today, in addition to having an in-country partnership with him through a number of entities that he manages, we retain interest in all of these licenses. So to sort of narrow the aperture a little bit to what everybody is certainly who follows the exploration business is focused on, which is the Orange Basin in Namibia, just to unpack a little bit our exposure there. First off, we maintain an interest in PEL 90. This block sits immediately above Total's developments at Venus and Venus West, now called Nara. When we were initially introduced to Knowledge, this block was operated by Tullow. Tullow exited this block as a result of not completing the final step of the first exploration period, specifically being a 500 square kilometer 3D seismic shoot. So they exited this block in January of 2022. We subsequently farmed out to Chevron, and we can talk a little bit about that at the moment. It's currently operated by Chevron, who's got an 80% working interest in this block. Secondly, we have an interest in PEL 83. This sits immediately above the blocks where Shell is prosecuting its discoveries, including the basin opening discovery at Graph, as well as Jonker and Lerona. This sits immediately beside the Kudu gas field. Galp went through a long process to try and farm this out, had very significant interest, but as a result of sort of the emerging developments in basin and improving insights from a geoscience perspective, is going to proceed with an initial exploration program, which we'll describe in a few moments. And we, through our local affiliates, maintain an interest in PEL 83. It is home to some of the largest in-basin prospects, and is a really exciting block. It's in much shallower waters in certain parts. So the potential kind of commercial prospects here are very exciting should we arrive at those finish lines. And lastly, we have an interest in PEL 87, which sits immediately above PELs 90 and PEL 83. This is home to the Saturn superfan, which I'll describe again in a few minutes. This block is operated by Pancontinental, an Australian company. Earlier this year, Woodside entered into an agreement which required them to spend or to complete a minimum 5,000 square kilometer 3D seismic shoot in order to earn the option to become the operator of this block and proceed with some exploration drilling. And so they are in the throes of that. And, as I said, no one has the kind of exposure in the heart of Namibia's Orange Basin that we do, partnered with these operators. And as I said, there's no further capital required from us to get to some of the near-term finish lines. So just to sort of unpack maybe, and there's a lot on this slide, to unpack a bit of the kind of the time sequence, we closed our acquisition and our partnership with Knowledge in March of last year, and the intervening period's just been tremendously exciting, as Gill has described. In the timeline below, you'll see certain events identified in blue. Those pertain to developments on our 3 blocks. Above in black are the developments in progress on the Shell and Total blocks. So as I said, we were introduced to Knowledge in June of 2021. We entered into an agreement with him in October as a result of just a fairly protracted process with the TSX and the commission. We were unable to close our transaction until March. In the intervening period, Shell had its discovery at Graph, which opened the basin, and then the Venus discovery occurred 20 days later, was announced 20 days later. And since then, we have continued, as I said, to see very significant progress. One of the commitments or sort of things that we told people we were very focused on during the financing we did in conjunction with closing was getting, the blocks farmed out where there was not existing farm outs. As I described, we were able to successfully bring Chevron back into the country through Knowledge's efforts. They had been in country a few times before. They actually found the Kudu gas field in 1974, but they returned to Namibia through their entry in PEL 90, where today they are the operator with an 80% interest. In consideration for that, they made our local affiliates and us, by extension, a small upfront payment. They as well carried us on a $40 million 3D seismic shoot, which was entirely coextensive with the entire block. They've shot almost 6,500 square kilometers of 3D seismic over PEL 90. And they are in the throes, all of the local partners are in the throes of analysis and integration with a view to developing and high-grading a prospect inventory. In March, we were able to announce that Woodside had entered into the option agreement that I described earlier on PEL 87. So essentially there, they were required to make the 3D seismic shoot in order to earn the option. Should they choose to elect to trigger that option, they would take up 56 points of the license, 55 from Pan Continental and 1 from us. They would carry us on 1 exploration well. Both PELs 90 and PEL 87 contain bonus mechanisms which would allow us to stay with further activity should there be discoveries. So we are certainly carried for a material period of time through the initial exploration efforts here. And around us, there's just been very significant progress. As Gill talked about, Total is very active on its block, spending half of its 2023 exploration budget on its blocks immediately south of PEL 90. Shell has applied to drill up to 10 wells on its block. It's had multiple discoveries. Gill talked about upstream. I think there was an upstream article around the time of a flow test on one of its wells that was titled Like a Train. So they've seen very good progress on their blocks. So we have just been extremely pleased with not only the developments on our blocks, but as well just the in-basin level of activity. Looking forward, this timeline is entirely illustrative, so I'll just make that qualifier. But we expect a very busy and exciting kind of 4 to 6 quarters here. Just to run through the activity on the blocks, and I should just note all of the activities in the purple rectangle require no further capital from us or our local partner. And so on PEL 83, Galp entered into a contract with Odafell, I think it was about a month and a half ago, for a deep sea semi-submersible rig called Hercules. This is currently in Norway en route to Canada, and then will be in Namibia in late Q3, early Q4. The initial contract is 115 days for 2 wells and testing. And so the expectation is that Galp will initiate exploration activity, drilling activity sometime in early November. As I said, it's a 115-day contract unless the option is extended. And so we would expect results from the Galp efforts on PEL 83 sometime early next year. On PEL 87, Woodside entered into its agreement in March. I think they had completed a upsized 3D seismic program over the entirety of the Saturn superfan, like in less than 2 months. So that has now been completed. They are fast tracking together with the local partners, the analysis and integration. They expect results to be available by the end of the summer. So let's call it late August, at which point their option would become effective. They have 180 days to trigger that option. but as you might expect, drilling tends to follow seismic. And so we would expect, again, subject to rig availability, that they will be on the block drilling wells beginning early next year. And again, just to reiterate, Pan-Continental actually carries us far beyond the initial exploration period, but the Woodside agreement would allow ourselves in Pan-Continental to stay with at least 2 exploration wells. To describe Pel 90, Chevron has been doing a ton of work together with our local partners on sort of basin level modeling, integration and analysis of the acquired 3D data. It was shot over the entire block. There's extremely exciting prospect inventory here. And again, no commitments, subject to further consideration and determination by the working interest partners, but the expectation is they will be complete, the analysis and integration, by the end of the year, with a view to be drilling early next year. And again, our agreement with Chevron provides us runway on at least 2 locations. So again, we expect an extremely exciting 4 to 6 quarters in basin, and we are sort of free from any capital requirements to get through the efforts that are shown on this slide. So just to provide just another perspective, I guess, on why this is so exciting to us, certainly, and hopefully to others, it's just the sheer scale of the opportunity in Namibia. If you look, for example, at the Saturn Superfan, this graphic on the right, we graciously borrowed from Keith Hill at Africa Oil. But the Saturn Superfan, located almost entirely in Pella 87, the Woodside block, is a 2,400 square kilometer subsea feature. The Venus fan, home to Venus 1, is 1,000 square kilometers. If you compare that, and admittedly there's no linear transformation between aerial extent and necessarily recoverable barrels, but as a barometer of the potential. If you compare that to Jubilee in Ghana, which is one of the largest producing fields in offshore West Africa, Jubilee is 180 square kilometers. And Marlim in the Campos Basin, one of the largest fields there, is 150 square kilometers. So Saturn is 15 times the size of each one of those, and 7.5 times the size of both. I mean, just the scale of the opportunity is truly breathtaking, and we're very much looking forward to the emergence of the potential over the next few quarters. And so just to provide the other leg of why we're so excited and so grateful to be where we are. We, as I said, invest globally. We invest across the E&P spectrum, and we have the benefit of extremely exciting investments in many companies. But the confluence of potential in terms of sheer scale, as well as activity, on the block shown in the graphic in the right, there may be more wells drilled here over the next 12 months than have been in the last 5 decades. This confluence of potential and velocity exists nowhere else that we've seen. And in terms of creating a portfolio of optionality, it really provides just an unrivaled opportunity. And so this is, in a nutshell, why we are so excited about what's ahead in the Orange Basin in Namibia. So just to make sure we don't leave out our other favorite child, Gill did a fantastic job describing the Walvis Basin. We as well have an interest in a license there. Pel 82 was previously operated by Exxon. Exxon spent over almost $21 million on this block. 70% of this block is covered by 3D seismic data. HRT, which is the Brazilian company I mentioned earlier, has drilled a couple wells on this block, Marumbe and Wingat. They confirmed the regional extension and presence of oil-prone source rock from the Kudu Shale. Samples were taken from these wells. They were extremely high quality, light oil, kind of 38 to 41 API. And so notwithstanding the fact that much of the excitement is a little further south in the Orange Basin, we are extremely excited to have this additional leg of optionality in the portfolio. And as Gill mentioned, a lot of interest here to farm in and have people look, and we will continue to progress our efforts to find a partner for Pel 82. I think we've sort of hit the highlights on the management and the team, but as I said, a very experienced and diversified team with very specific relevant experience as it pertains to our strategy. So I think we can probably flip to the last slide. We really feel like it's the right time. It's the tremendous opportunity we've got ahead of us. Many people hard at work, and we're really, really excited. So thank you everybody for the time, and we hope you'll join us as a shareholder. I think that's it, Adam.
Thank you, Robert. Let's jump into some Q&A. First off, I'll ask the same question I asked Gill. You guys have great exposure to a large resource potential, but non-op. What is the overall strategy from the company? Do you eventually want to stay with the projects and eventually take production, even though that production still might be, quite a few years out? As guys get through exploration and then a development plan, or is the idea to transform an exploration success result into an M&A transaction, sell off the remaining interest, and then move on to the next opportunity?
I will, as I tend to do, just kind of steal some lines from Gill, because I really do just want to be like him. But I guess I would say a couple of things, Adam. Like, it's not lost on us the scale of our company today. I would say that it's certainly from a family office perspective, and I think at Santana are in the value maximizing business. And so if the strategy to maximize the value of our assets is to be able to stay with them, we would certainly consider it, but it seems hard to contemplate given the scale of our company and the potential scale of these developments. Like, just as an example, the phase 1 Venus development could cost $10 or $12 billion. That's bigger than the GDP of Namibia. Like, these are huge developments, and it just seems hard to contemplate. We have relatively modest interests in these blocks. So I think the idea is to really create and participate in the exploration and discovery value, and then probably look to monetize. But again, situation specifics and value should always govern what we ultimately do. But I think the idea here is really to deliver exploration style returns by participating predominantly in kind of that phase of life.
Okay, great. Question from the audience. There's nothing mentioned on the land block in Namibia. What's happening there?
So again, we tried to, just given time today, really focus on where we see the most amount of excitement and near-term trajectory. So yes, we do retain an interest on an onshore block, PEL 103. It's located not too far from kind of the ongoing exploration efforts. That was a 5-year license that has very nominal work commitments. And so we really are just kind of holding that, kind of pending the onshore developments and kind of seeing what happens. It costs us virtually nothing to maintain. There has been actually some interest to maybe do some stuff with that block from external parties, but at the moment, we just have it in the inventory and we're meeting our commitments, which are very modest, and kind of letting the onshore story develop before we really figure out what to do. And needless to say, we've just been so focused on the offshore blocks, particularly in the Orange Basin over the last little while, that it's just trying to focus bandwidth where it's most productive.
Understood. And maybe a related question: what's the plan near term and kind of medium term in Colombia?
Well, that's subject to some discussion, and I can't say too much about it. There's an ongoing process there. We've had that asset in Colombia for over a decade. We've been in partnership with Exxon on that asset. They're very good partners of ours. They have been partners with Knowledge in Namibia, and so we're sort of working together to find out what makes sense. I think you alluded to it, Adam. This country has had a tremendous history of a very significant and material hydrocarbons business, and a lot of that came from Canadian companies, or Canadian domiciled companies anyway, and that to some degree is kind of how Santana was reformulated in 2012. The current complexities in country really sort of complicate what happens next. And so I think, together with Exxon and Exxon's relationship in country, we're trying to kind of figure out, what we can do to sort of best preserve value there. We are extremely convinced about the geologic prospects of that block. For people in the audience who followed the story, Exxon drilled a single vertical well on that block. It was fully cored and logged. It returned hundreds of feet of oil-thick shale. It too is like the Eagle Ford, going back to Toby's talk. It's really just trying to understand how to take that geologic opportunity, given the overground complexities, and put it on track for something to happen. And it's sort of a difficult time at the moment to really understand how that happens. But needless to say, we're working hard with our partner to figure out what to do.
Okay. Another question from the audience: why didn't Santana buy the remaining 51% from InterOil?
in order to preserve the structure of the JOAs and some of the mechanisms in the JOAs, including the carry, there could not be changes in control. And so we structured the transaction to preserve knowledge's control of those licenses and the entities that hold them, so as not to endanger the terms of the JOA. So,
okay. Over back to the offshore stuff. What value enhancement is Woodside doing on their 3D seismic shoot? Given that the Saturn fan's already, essentially been kind of outlined.
Well, the Saturn superfan was fully mapped by Pan-Continental, but overlaying that with 6,500 square kilometers of modern 3D seismic is a huge leg up. The data quality that has come back from the Woodside shoot, we understand from them and our local partners, has been very good. So it gives them much better visibility and precision into kind of the geologic opportunity. I think as well, all of these efforts are trying to better tie basin-wide discoveries. So acquiring lines which better align Venus, Graph, Jonker, Lerona to some of the prospect inventory on these blocks is a key part of any geoscience exercise in the basin at the moment. So, Woodside shooting a modern 6,500 square kilometer 3D seismic shoot over the block just dramatically enhances the level of visibility into the prospect inventory and the precision with which they can sort of begin to high grade and identify where things are.
Right. And then obviously this area has really started to pick up in terms of the activity levels. Any concerns around, maybe some delays in some of the timing that you've outlined, just given, securing rigs and access to services?
Absolutely. That's always a prevailing concern. I mean, I guess I would say a couple of things. One, Galp has already contracted for the rig, so it's, nothing's ever a certainty, but that's already been contracted for, and they've been planning on and working with the service providers on this opportunity for some time. So we certainly feel good about where that is. Chevron and Woodside, as to their rig acquisition plans and how that works. I'm not privy to that, maybe to some degree unfairly. We kind of believe when you're Chevron or Woodside, you have good access and there may just be constraints on availability. But I do know that, given the way in which they are endeavoring to execute the geoscience, spend the capital and move at once efficiently but thoughtfully, like they are very focused on getting to these timelines, we think. But it is certainly subject to slippage for sure.
Yep, great. Well, thanks, Robert, for taking us through the Santana story. Very interesting, high impact potential here. We are on a tight timeline, so we'll thank Robert for his time and move on to our next presenter.
Thanks so much, Adam.
Okay, thanks, Robert. So next up is a private company, Gill Energy. They are focused on gas opportunities within Turkey. Obviously, we all know that European gas prices have been quite volatile to the upside, which is always good for the producers, maybe not so good for the consumers. But obviously, the continent is looking for additional sources of gas outside of Russia being a major supplier, and Turkey has started to show a lot of potential to satisfy some of those needs. So with us today is Michael Volko from Gill, Chief Executive Officer. I will pass it on to him to take us through the story, and we'll wrap it up with a Q&A after 20 minutes of presentation.
Very good. Thank you, Adam. I'd like to start the presentation with the number 11. And you might ask, well, what is the significance of number 11, notwithstanding it's Mark Messier's jersey number? But that is the difference between NYMEX, the front month contract for North American or American gas at $2.50 today, and the current monthly gas price in Turkey is $13.50 US per MCF. So it was interesting to listen to the previous two companies who are exploring in the hottest basins in the world, the hottest basin, the Orange Basin. We are certainly have an asset in Turkey, which is the hottest gas market in the world today. And certainly we've seen the volatility in European gas prices over the last 18 months since the Ukraine conflict started. As Adam said, the volatility is there, but certainly there is more upside to gas price than we think that is downside. So Gazelle is a private company focused on international E&P. The co-founders of the company all have prior extensive international experience, and of course, anyone who or the companies that are presenting here today recognize the difference between doing a domestic asset project or doing an international project. The scale is much greater, the timelines are longer, but the potential of international projects certainly is there. And we have acquired our cornerstone asset, which is a petroleum license containing the Pelevankoy gas discovery in the Thrace Basin of Western Turkey. We've been at it now for a couple of years, taking our time and making sure that we have a good understanding of the geology, leading to a financing that we undertook last October, where we raised funding to drill and case our Pelevankoy 2 appraisal well, appraising the original discovery. A total depth is around 3,080. I'm very pleased to announce that we have commenced drilling, and we are currently at 1,400 meters and expect to reach the main pay intervals here in the next week or so. So a very exciting time for our little Gazelle here. And we're very, very pleased to be exposed to certainly the asset base that we've acquired, as well as the upside in gas prices. So clearly we are a small company. We are more or less self-funded. We are looking for basins with proven petroleum systems. We're looking for existing appraisal or discoveries that may be non-core or a marginal field for redevelopment. We are opportunistic. We came across this asset in 2018 and managed to acquire it for very, very little with respect to our work program, and we have very good exposure to the upside. Also, what in the last two international startups that I founded, I look for places where we can take our North American and our Canadian technology on drilling completions and reapply it to parts of the world that just haven't seen that sort of innovation over the past life of the mature basins that we have. So we are very opportunistic. We have a great asset here with excellent economics, and certainly we will have some completion results in the fall, end of August, and perhaps on into September. The location of the Pelevankoy gas field is in Western Turkey. It's about 180 kilometers from Istanbul, about 50 kilometers or so from the Greek border. It's an excellent area to operate. It is rolling farmland, small villages, a few small towns, but certainly easy access. And we've had nothing but great compliments from the locals there in terms of our interaction with them and their support for the industry there. They recognize that developing the local resource base is good for the country, and the government as well has been very, very supportive. So we have an excellent operating environment there. The Pelevankoy discovery was actually drilled in 1992 by Turkish Petroleum, the state company. We have collected all of the G&G data, including a 3D seismic program that was acquired in 2005 that fortunately turned out to be very, very good quality and saved us $2 million from the work program that we bid, which included some 3D seismic on the license. So we purchased the digits for the nominal sum of $26,000, had it reprocessed in Calgary at Key Seismic, and certainly it is excellent quality. The gas pay lights up with seismic amplitudes. We have a number of other prospects that we've identified that have yet to be drilled. We think there could be in excess of a TCF of gas based upon some volumetric estimates of the other prospects. We are currently drilling our high impact twin of the existing discovery well, Pelevankoy 2. We had a recent D&M report done. We have 27 BCF of 1P, 65 BCF of 2P, and 3P is 376 BCF. So certainly a significant upside potential for a very, very low cost of entry. Just briefly about our leadership team, Ken McNeil is a well-known Calgary-based landman. I think he started 10 or 11 companies in Canada. He's been with me on my prior two startups internationally, the first in Kazakhstan, the second in Oman. I'm the CEO. I've spent the last 30 some odd years of my career internationally. I love it. I love the travel. I love meeting the new cultures. I've made many, many good friends that the sad thing is they live in other parts of the world because they would be friends in Calgary if they happen to live there. And then lastly, we have David Kiselewski as our EVP Exploration and COO, another seasoned international explorationist who's had exposure in many different countries in the world. So we're not naive about the international game, but we are in fact thrilled by the opportunities that present themselves, as some of the other companies here in this conference can also attest to. Just a little bit about prior successes. I don't want to bore you with the details, but we've been involved in 5 international startup successes. This would indeed be number 6. We are hopeful that we can continue our track record. It's not easy. We have challenges with respect to raising capital, being a private company, but certainly in my last success, which was in Oman, we managed to sell for $30 million to EOG Resources out of Houston. A very nice turn on the dime for our shareholders. We look at this asset as a similar track record in which we've been able to acquire good assets organically for very little upfront cash. We haven't done any acquisitions. This is all organic identification of these opportunities, pursuing them, and ultimately bringing them into the company or a company. So we hope that this will be another success under our belt. A bit of a timeline. We were incorporated in March of 2018. We were awarded the block in January of 19 after a competitive tender. We were delighted to have been awarded the license. Indeed, one of the competitors in the tender was Turkish Petroleum, the state company. And as we were told at the time, that generally Turkish Petroleum, whatever they want, they get. But we hit the Ministry of Energy at the right time, where they were changing their philosophy that TPAO probably has enough on their plate in terms of acreage. And certainly, given the most recent multi-TCF discovery they made offshore in the Black Sea, that is probably the case. So we awarded the block. We worked it up from acquiring the existing geological data. Then we took a 2-year COVID hiatus, not being able to raise any funding or being able to travel to Turkey here. But we resurrected our efforts in the summer of 22, leading to the closing of our private placement in October. That got us going here. We contracted a rig in April, and as I mentioned, we are currently drilling on site here today. So it's been a bit of a long road, but as I said, these international gigs take a little bit longer, and we do appreciate the patience of our shareholders, but definitely the potential that we have for the limited amount that we acquired the acreage, I think, is a very good risk-return relationship. We also have a number of new ventures in the pipeline, again, looking for good assets that we could acquire cheaply. And then we do intend to continue with the appraisal and development and production of this block. It is well within our skill set, being onshore opportunity, moderate depths at around 2,000 meters. So certainly we would be delighted to bring this into production here over the next 12 to 18 months based on the success of this initial well. Strategic basin, and it's in the Thrace Basin. It tends to be gas prone. It's a very, very good area from access point of view, rolling farmland. There is good gas infrastructure here. There are a number of players, including TPAO, that are producing from the basin. So in terms of accessing markets, it's very, very well situated. Here's the strat column for the basin. Fortunately, we have multiple pay zones. You'll see the stars there denoting various intervals that currently have production in the basin. We are looking at the red ovals, one being the Meserdare Teslimkoy member, and then lastly the Echelon. And I'll talk about the Teslimkoy here in the next slide. But the Echelon is a deeper basement target. It's actually a fractured volcanic or tuff play right on metamorphic basement that has been discovered recently. And we know that 2 other operators have made recent discoveries very, very close to our block in this J-land formation. So we will be drilling down to test that at around 3,100 meters here once we case off the main Teslimkoy pay interval. And we're excited about the prospects of that J-land deeper potential. Just a little bit about the basin. Probably everyone's familiar with the Valeura story. Valeura having a deep basin-centered gas play, which they have been pursuing for a number of years. They drilled 3 wells into the play, got some modest gas rates at around 4,000, 4,500 meters. We are in the sweet spot in the basin in which we are shallower, say around 2,000 meters, so much less expensive drilling. And there are also some shallower plays at around, let's say, 1,000 meters. So we have the depth to be have higher potential for higher reserve volumes, as well as deliverability, without the extreme well costs that would be experienced by drilling for a deep basin-centered gas play. We are pursuing the Tesla-Koi, which we think is a turbidite fan. And when I'll show you a seismic amplitude map, and clearly it has that elephant footprint that very much matches what we think the depositional environment is. Here's what got us excited about the acreage that we acquired. This was, again, the Pelevankoi 1 discovery well. On the right-hand track, we see 41 meters of gas pay that tested at low rates. We think this is a tight gas play, not unconventional, although we do speculate that below this Tesla-McCoy pay, for about 700 meters down to basement, we have gas shows, and we do think that that is likely an unconventional play that could be pursued, say, in the third phase of our efforts there. So there's no shortage of gas shows on our acreage, and we do have very clear gas pay within the Tesla-McCoy members, which is our main exploration target. Here is a seismic cross-section showing the Pelevankoi 1 discovery well. Again, excellent quality seismic. You can clearly see the reflectors. We see gas being trapped up against a fault there. We can see also some amplitude anomalies deeper in the section here, which will be tested with this Pelevankoi 2 well. So we're absolutely delighted that we can see the seismic, or the seismic clearly shows good reflectors that are easily mapped. And now it's just a question of demonstrating they're gas saturated and at what rate the well will produce that. Here is the seismic amplitude map. So clearly it's very closely tied to the two pay intervals in the Pelevankoi 1 discovery well. You see the bright spots clearly indicating Tesla-Koi pay and amplitude anomalies. We've done extensive AVO work, and we are convinced that the reflectors demonstrate an extension of the gas pay tested in the Pelevankoi 1 well. And then we have pretty much room to run in terms of additional appraisals around the P2 first appraisal well. Here's our reserve summary and some net asset values. The gas price that was used here was Sproul of January 2023. Things have come off a little bit, but very, very healthy net asset values. And in addition to the 1P, 2P, and 3P reserves that DeGolyer and McNaughton estimated for us, they also estimated a number of three prospects with prospective resources to enhance the resource potential of the block after we prove productivity of the Tesla-McCoy pay. Just some development scenarios on the 1P, 2P, and 3P case. Again, the peak in production is highly dependent on the reservoir. We certainly don't want to, and we do have modeled to date pretty significant initial declines based upon our speculation that it's a tight gas development, and therefore we can expect pretty significant decline rates in the first year, not unlike some of the unconventional wells that are being drilled in Western Canada. However, there is some optimism that we may have better permeability, which this well, we're going to do extensive coring and gather significant amount of core data and modern log data, really to study the rock and make sure that we understand what is going on before we embark on a completion and probably a stimulation design. So the price or the production forecasts really reflect a tight gas development, and in certainly no way is it optimized, but we will review it once we get additional well data from the appraisal well. Again, we probably will use horizontal multi-stage fracs. It's well-worn Canadian technology, and this is one of the things we are going to bring to Turkey. There's been a few attempts in the past, but nothing in a significant way. So we are spending not an insignificant amount of capital acquiring geological data. It all starts with the rock. We want to make sure that we understand it. We have a good view on lithology, clays, shales, silicon content, just to make sure that we can properly design a stimulation for it. So again, we're using technology that's well worn in Canada, but bringing it here to Turkey. Financial overview. This gives us, again, some development potential for the three cases, the 1P, 2P, 3P. We are looking at very, very healthy economics, very, very healthy IRRs for this particular, or for each of the three development scenarios. Again, some more development and scheduling from the 1P case. We are now well into Q2 of 23. We are off and running in terms of our development schedule. And as I said, we'll have some test results after the completion, likely in early September. We look forward to getting after it with a number of other appraisal wells, and then immediately going to production by the construction of a pipeline to one of two possible tie-in points that we've been investigating. This is the 2P development. Again, we want to get after it aggressively once this well is down, which would likely involve us seeking additional financing, probably through an offering, a public offering of some sort. So we're not going to be too shy about taking this and developing it ourselves. I think we'll do a very good job at it with bringing Canadian technology, and certainly we're very, very capable of doing it. Fiscal regime is absolutely fantastic. 12.5% corporate royalty on oil and gas production, 20% corporate tax rate. The contractor take is very high compared to other jurisdictions in the world. So, and that combined with the very high prices for European natural gas, any sort of sniff of gas is very, very economic and has a low threshold of commerciality given the proximity to tie-in points. So we're highly confident that with a proper well test, we'll be able to tie this gas in and get generating cash flow here very, very quickly. For close tie-in point, it's about 24 kilometers. Again, quite easy access. So we shouldn't have any issues in getting this initial well on production as soon as possible. This is also very, very exciting. And again, the hottest gas market in the world at the moment. You'll see the bold red color is the price for Turkish gas in US dollars per MCF. We had a considerable peak last December, peaking at $32 an MCF. I think we in the industry, while we are delighted to be exposed to that sort of high prices, clearly it is not sustainable from a country's economic standpoint, and therefore demand destruction as a result of difficulties in such high energy prices are quite reasonable. But we are expecting long-term prices to be in the $10 to $15 an MCF, potentially peaking in the winter seasons when, based on a cold winter in Europe, we might get some spikes. So clearly it's a very, very good gas market. And you note that even in the depths of COVID, prices did not drop below $5 an MCF. So I think we have a very good manageable floor price on gas, and clearly are exposed to the upside that we believe will happen in the near term in the European gas market. Cash flow summary, this project will generate significant cash flows based upon even modest production forecasts. And of course, if the 2P case or even 3P case on the Pelevankoy gas discovery are realized, plus one or two successes on the prospects that have yet to be drilled, this will be a significant cash generating asset that we wish to certainly retain as we go forward. Full cycle economics, again, very, very attractive, very good F&D costs, right around $10 to $12 per BOE. We're expecting pretty modest drilling costs are manageable, given that it's onshore at moderate depths of around 2,000, 2,200 meters. So this is tailor-made for a Canadian style of rapid, clever, appropriate, optimal development, and that's certainly what we are intending to do on this project. Again, looking here is four of the prospects that we have on the block. We see, again, the same seismic amplitude character. We are absolutely frothing at the mouth to get a well into each one of these to determine what they may be, because clearly we think there's additional potential for additional resource or additional reserves to be discovered on the block. Again, this is our summary. We are experienced management. We're a private company, so we have the pain of perhaps not as good access to capital as being in the public markets. But on the other hand, we are 100% of the asset. We are private. We are funded to drill and complete this well. We have a very, very near-term high-impact drilling opportunity that we're currently pursuing in the best gas market in the world. And we have a number of other goodies that we are pursuing here on the backs of our discovery here at Pelevankoy. And that's it. 2 minutes over. Apologize, Adam.
No worries. We still got lots of time for Q&A. Thanks, Michael. So maybe first thing I'd ask is, obviously you got a tight gas resource. There's lots of precedent for development of those type of resources in North America, but it's a little bit of a newer technology being employed in Turkey. How are you going to access frac crews to frac the wells?
Yeah, there is a nascent stimulation and pressure pumping industry in Turkey. I mean, the industry has been active for going on for over 40 years, perhaps on even to closer to 50 years. So gas is being produced and discovered from shallow conventional reservoirs, but there is a pressure pumping industry that is present here, and we've had numerous discussions with them during the pre-planning for our stimulation and completion. It's really the horsepower at surface needs to be appropriately applied downhole, and that's what we bring is the proper design of the downhole portion of it. How do you design a multilateral or multi-fractured well, given that you do have access to the horsepower at surface? And I think if we can prove up that this is indeed commercially productive from these, even from a vertical well, then of course success brings other entrants into the area. So we don't think that the horsepower is the issue. It's properly designing the stimulation, which is what we do very well coming from the Canadian industry.
Maybe just on the gas markets, obviously, you highlighted the prices were quite robust, and even got quite elevated last winter. Just, what are your kind of thoughts on the macro price environment for Turkey and the rest of the continent, and how long could we see, this kind of sustained elevated price last in your view?
Yeah, my own view is that, first of all, the major supplier to Europe being Russia, I think no one is going to trust Russia for decades. And therefore, you can almost take that gas out of the European market, I think, given the application of sanctions and the desire of European nations to try to find other sources. And of course, the major source then is LNG. So my view is that European gas prices, notwithstanding seasonal volatility, on the upside, I think, really will settle in onto world LNG prices. And I think if given the transportability of LNG worldwide, the floor being more or less the LNG market in the Far East, I see gas prices being in the $10 to $15 an MCF range for the foreseeable future, with periodic spikes to the upside based upon unseasonable weather in the winter months.
Yeah. And, just as you kind of get to forward in development, is there an active market to actually hedge your volumes within Turkey, as you maybe want to try to capture some of these prices and sustain them? Or essentially, are you would it be applying a dirty hedge using one of the benchmarks on the continent?
No, there is a forward market in Turkey. It is not terribly active, given the fact that TPO is the major player, and the government is encouraging them to sell their gas immediately into the market. But the moment there is the possibility to forward sell for 12 months out, and as soon as we get production volumes into the pipeline, we will be exploring that as a potential hedge.
Yep. How much capital needs to be put into to surface facilities? Is this a clean gas stream, or is there other molecules in there? Whether it be a CO2 or an H2S or anything like that needs to be removed from the stream before it's market ready?
No, we don't anticipate it. Ironically, the BOTAG, which is the National Pipeline Company, has a remarkably high nitrogen content standard. I believe it's 5.8%, which is unheard of in most international jurisdictions. So the market already takes from other producers, and we're not sure what our analysis is going to be, but they're already taking what you would call less desirable gas, because again, they're hungry for domestic production. Our own view, based upon the analysis of the test that we got from, or the analysis that we got from TPO, we're looking at probably 8 to 10 barrels a million. So it's not hugely liquid rich, and any sort of more extensive processing other than doing a dehy, taking out the water and doing some condensate separation either at the well site or at a simple gas plant will really be dictated by the gas analyses that we will collect from the extensive testing that we plan to do. So we do have in our economics, we do have two scenarios. One is strictly just a simple dehy compressor and putting it into the system that way. And the other one is having a little bit more processing in order to collect some of the condensates that are there.
Okay. But you can put those condensates as well if you want to go the simpler route right into the pipeline, just given that they they take a less stringent stream.
Yes, that's true. And if you look at the Botage heat content requirements, it is quite a liberal pipeline grid that they've developed here. So again, the notwithstanding you would need to meet the dew point spec on the gas, it does take a rather higher heat content for gas that's put into the pipeline system. Yes, it does.
Understood. And we'll wrap it up with this question. Do you see the opportunities to expand your footprint in Turkey or maybe some of the other nearby area in the near term?
Yeah, yes, we do. And we are in discussions with a couple of other operators here about looking at their acreage. I think now that and really a lot of it will depend upon basically the flow rates that we're going to get from the Teslamcoy, but also this Echelon I think could be a huge company maker. We're hearing some discoveries made by other companies. So once we get a handle on how the seismic is tied to the Echelon, and can we actually see it, and then obviously is it productive, then we'd be looking at a Echelon centered exploration acreage on additional licenses in our vicinity there. So we think, notwithstanding we've got a very good asset that we acquired for nothing, we do see the potential to grow our asset base in Turkey, but also we are looking at a couple of other projects elsewhere internationally, again, looking for those unique opportunities that we can acquire them organically for very little upfront, but yet have a quality asset behind them.
Great. Well, that takes us to the bottom of the hour. I'd like to thank Michael for coming in and presenting the Gazelle story to us today. And we'll move on to our next presenter. Thank you, Michael. Next up, we have Dekla Resources. The company is focused on reviving some older fields in Nigeria. We have Sanmi Famuyide, CEO of the company, presenting to us. Interesting story here. Obviously, you know, the oil is understood, and it's just about reviving some of these fields and you know, taking them to the next steps of more mature and extending the resource life and capture in these opportunities. With that, I will pass it on to Sammy to take us through the Dekla story.
Thanks for having me again. Thanks for the opportunity. Dekla is a Toronto Stock Exchange listed company. Our focus is on low risk appraisal development opportunities. We currently have 3 assets with very attractive netbacks. The first deal using the asset company Dekla Petroleum was via a risk service agreement with Millennium Oil and Gas on the Ozo field. For that field, resumed production in July 2022. And the evacuation has been via trucks to the Umugini pipeline and eventually evacuation through the Shell Forcados Oil Terminal. Also, we've been able to evacuate to 2 local refineries in Nigeria using the same approach. Production from the asset from Oza is about 1,000 barrels per day of 32 degrees API crude. So aside Oza, with the Dekla Petroleum asset company, we have 2 other fields also under the similar risk service agreement structure. We have the Emoha field, which was announced June 2022, and the Asarma Toro field that we announced November 2021. Have the benefits of having worked very closely with a team that have deep experience in oil and gas in Nigeria and know how to operate assets here. I guess over the next few slides, I'll describe Nigeria. It's a well-known oil and gas location. Reserves is considerable, still arguably the largest in Africa. Current production averages about 1.4 million barrels per day. It's inched up. There was a dip recently because of issues with evacuation. The new government has been very focused on ensuring that the security on the evacuation infrastructure improves. So we've seen that tick off in the production volumes from close to 1 million, slightly below 1 million barrels per day at some point, as a matter of fact. The target is closer to the 4 million barrels in about 7 years. The country has benefits of over 1,000 individual fields all around the Niger Delta. About a third of that are producing. It benefits from a long-standing presence of international oil companies and independents. In our view, the risk-reward profile is very attractive, given the numerous number of proven undeveloped fields, very attractive fiscal regime, good infrastructure that has served the sector for several decades. Then there's a thriving service sector to support the sector, and a developing potential and developing oil and gas, developing gas markets, LNG certainly out to the market, and there's significant market for local gas consumption. There's a lot of incentives we see and upsides from the new Petroleum Industry Act. So we see the next sort of few years significant growth, as I indicated earlier, in Nigeria. The Marginal Field Program, which was launched in 2001, was to grow the modest-sized independent and indigenous oil and gas companies. These are fields that were previously owned by international oil companies, so the Shells, the Egypt, the Totals, and the state oil company NMPC, but have remained non-producing for over 10 years. Over 130 of these fields were identified and put into a program. So there was a bid run. The first bid was run in 2003 of 24 of such fields. There's another field run recently, about 3 years ago, 57 additional fields. The attraction here, compared to the historical assets, the incentives are very attractive fiscal terms. So the royalties are much smaller, and the petroleum taxes also. The royalty structure is actually a sliding scale sort of arrangement, so that one pays a lower royalty value when the production is still modest, and it sort of ratchets up as production increases. So this is the royalty structure for a typical marginal field in Nigeria, as I described earlier. A royalty structure that is in sliding scale, so the economics remains attractive for a smaller production scenario. Taxes are attractive too. For our case, with a risk service agreement structure, we actually pay the corporate income tax. So the economics is strong. For the risk service agreements, we're responsible for funding 100% of the capital expenditure to develop the assets that we enter into the agreement with. So typically, there's an accelerated repayment period where we get 80% of the distributable funds as cost oil, and thereafter it ratchets down. We have a unique sort of commercial structure where that entitlement sort of ratchets down. So depending on where we are in the cumulative barrels produced, we're either at 80, we're somewhere between 80 and 40. So following full cost recovery, we're entitled to 40% of distributable funds. Well, as I described, that is after a significant amount of barrels have been produced. Okay, now to the first asset. So this was closed in June 2020. Very attractive assets, onshore conventional oil field, is on dry terrain, is on land, is on the Irma 11, which is a very prolific oil block. I think there are about 30 discovered fields on these assets. So naturally, there's excellent infrastructure in place for pipeline evacuation through the Shells and Trans-Niger pipeline. So flowing down Irma 11 to the Bonny export terminal, which is currently the largest oil terminal in Africa. 3 wells have been drilled previously on the Oza field by Shell, and over 1 million barrels produced. 2 wells tested about 2,000 barrels per day of light crude. Very strong in economics, about close to $50 per barrel net back in an $80 per barrel scenario. We are currently producing about 1,000 barrels per day of light crude and an average gas of about 71 million scf per BOE. As I indicated earlier, we produce currently 2 on-storage storage tanks, and evacuation is either to the Mooney Pipeline Infrastructure Limited company for onward delivery to Shell or to 2 local refineries. We've had to look at an alternative evacuation system that was separate from the Trans-Niger pipeline because of disruptions to the evacuation in the last few years. The excitement now is that in the last sort of 6 months, there's been deliberate effort to invest by the country in a security infrastructure that ensures that oil is evacuated without disruptions and without loss. We've seen that successfully work on the western side of the Delta with the Forcado system. The losses we see there have dropped from the 60s to 80% to less than 10%. And so we see that continuing. On the east of the Niger Delta where we are, data we get is that the TMP is up and running. And as a matter of fact, the main numbers recorded 0 loss. So we're very excited. We're watching this closely, and we're speaking to SPDC. The intention is to resume evacuation using the pipeline system in about a month or so. Oza is a stacked structure. What that means is that we can complete using dual completions, vertical wells, horizontal wells. So production per well, typically from what we've seen, we can get anywhere between 1,500 to 2,000 barrels per day per string. So if we have a dual string completion, that's about 2,000 to 3,000 barrels per day. So from a return per well, we like a stacked reservoir structure. Focusing on Oza, in the next 6 to 12 months, we target 1 to 2 development wells. We're excited that the pipelines are back on now, and the curtailment headache with evacuating using trucks is, if I'm allowed to use that, out the door. So we can bring in those wells, install a CPF and infrastructure to tie in the new wells. We estimate about 25 to 30 days for completion of each of those wells. The intention is to bring that production online very quickly, and follow on with the phase 2, where we will be drilling up to 6 development wells, similar sort of turnaround time for well. So we estimate that additional infill drilling wells every 60 days. So aside the other field that is producing, we have 2 fields, as I indicated earlier. There's the Asaramoturu field, which was also previously operated by Shell. The attraction here is that this well is produced before. It's done some very good numbers. There are 2 wells on the field, each have done about 3,000 barrels per day. The challenge the previous asset owners had was they started evacuating at a time when Nigeria didn't really have alternative evacuation infrastructure. So they were barging. They were barging to a location that was quite far. So as you can imagine, the evacuation costs were prohibitive. The plan for us is to re-enter those existing wells, reopen the wells, depending on where we eventually firm up the plans for bringing the assets into production. So we could either re-enter the existing wells or just reopen. Then, of course, follow it very quickly with new development wells and have new production facilities and flow lines in place. We'll take benefits of the improved evacuation system and the pipeline situation in the Delta and tie in production also to the TMP. So the asset is very close to the Bonny terminal, so it's a very short tie-in distance. Our gross interest under the risk service agreement, given current reserves, about 4 million barrels, but we expect that to grow as we unlock with more drilling. The second asset, also by Shell, previously owned by Shell, is the Immoval Marginal Field. Its attraction is also, as with the other asset, is its proximity to existing infrastructure. So we can very quickly re-enter the existing well. So there's an existing well that was drilled by Shell. And so the intention will be to re-enter that well and tie in to the Bonny terminal. So the Bonny terminal is also very close by. So we're tying to the TNP, the Trans-Niger pipeline, and eventually evacuate using the Bonny terminal. This is also a phased work program. The intention is to first re-enter the existing well, then drill up to 9 development wells. The asset is similar to Oza in that it's a stacked sand, so we will be taking advantage of dual string completions where we target multiple zones with one well. The DECLA team, most of the members of the team have worked together in either as advisors or in prior companies several decades, right? We understand the layout of the country. We understand the geology. We understand producing the company. We have very deep relationships with players, with financiers, and government institutions, which are very key if one wants to unlock value in a country like Nigeria.
Great, thank you for the presentation. Let's jump into some Q&A. So obviously, there's a lot of tired fields or mature fields that aren't getting the attention that they once were from the larger producers. Do you expect there'll be additional opportunities within Nigeria, and is there another bid round planned for some of these fields?
So if we look at the fields that are currently in the market from the 2021 round, there's still about, based on the work we've done, there's still about 15 to 20 attractive assets that we can go for. Whilst the plan is to sort of mature the assets we have, the 3 assets, bring them into production, and ensure we're evacuating. We are having conversations with partners that have assets that are attracted to sort of RSA structure in helping them bring the assets into production. The new administration is keen to grow production. They've set a target of about 4 million barrels 2030. They expect that production to come from the large sort of blocks that the IOCs will be attracted to, as well as from the sort of smaller size independents like ourselves. So we expect that there's going to be a follow-on round to this round, and as always, we will be very deliberate in the sort of assets we go for. So we will rank it. They have to be close to existing infrastructure, so we can evacuate. We prefer stack reservoir sands so we can take advantage of the dual string completions sort of approach we use right now, and where possible, where such assets come with gas, we can take advantage of the sort of policy shift we're seeing to grow the local gas market, so that the price per million SCOF is several multiples of what it is now, in the event that one doesn't choose to go the LNG route for export.
Great. How much, just in terms of kind of to maybe understand the risk profile of a reentry or a horizontal, what are the expected costs on a reentry and that horizontal at the OZA 1-4?
A reentry can cost anywhere between 2.5 to 4 million US, because these are land assets. New wells will be closer to between 10 and 12 million dollars. So as I indicated, the intention will be to follow those reentries with infill drilling, development wells.
In terms of the surface requirements, when you're producing from these fields, is the infrastructure that was already in place carry you along? If not, how much more new infrastructure will you need to put in? And is it a pretty simple stream of oil and gas coming back at you, or is there a substantial amount of water handling that needs to be done as well?
So for most of the fields, they're significantly dry. So what you see is oil and gas. And what often happens is, as you know, as the oil water contact moves, you start getting some water in. We have infrastructure for water separation on the assets, and also facilities to handle gas. When production is modest, we flare off, but there's investment currently to ensure that we can harness that gas. We're fortunate that the sort of infrastructure around allows you inject gas that is of varying spec. So there are gas processing plants that do the liquid knockouts for you. So you can actually start an operation even for a gassy asset. You can start operations with a very modest sized capex.
Just in terms of larger resource potential from the assets you have in play, is there any thoughts about moving to enhance oil recovery over time via water flood?
So for the assets we look at, the preference is for assets that have natural drive that go on for 10 years. It's very rare needing artificial lifts in Nigeria. Or what of the very rare instances where you have heavy oils, then you use ESPs. But that said, for some of the wells, we believe that as production sort of matures, there's opportunities to actually use gas lift because most of those wells come with gas, right?
In terms of local community, obviously communities in oil and gas areas not always opposed to development but want to benefit from development. What are you doing with the local communities to ensure they're on board with your development program?
So for most of the communities in the Niger Delta, you find out that the service companies that have the sort of key principles from those communities. What the first thing you do, obviously, is to engage the community of the plan, and where the expertise for certain work exists in those communities, you hand out those contracts. We've had instances where completions were actually done by a local contractor. That was the case in Oza. So where you have those local contractors work on the assets, then you're aligned with the community. Obviously, they're incentivized to ensure that you succeed.
You have a depth of experience in West Africa. Do you see opportunities similar to what Nigeria is doing in any of the other producing areas offsetting Nigeria?
We see a few, but I guess in the immediate term, there's actually more than enough opportunities for the sort of assets we're looking at right now. I mean, like the Niger Delta is actually really huge. It's almost a subcontinent kind of scale and size, right? So whilst the region is in the same country, it's actually quite geographically and geologically diverse and dispersed. So our focus would be in the near term, taking advantage of those opportunities. We see a few other rounds as IOCs sort of look for larger sort of assets and as the fiscal regime sort of incentivizes both oil and gas production. We think there's definitely very low-hanging fruits with a focus on the Niger Delta.
Obviously, the fiscal terms are pretty attractive relative to fiscal terms for newer developments. Do you see the current regime, being proactive in ensuring that more of these opportunities come to light, or was the 2021 bid round, kind of big enough to capture a lot of that upside that they see in kind of redevelopment in these fields?
So the part of the excitement is the new administration has been very keen and has actually indicated from some of the moves they made since they came to power. So security was one of the issues we had in Nigeria, with Nigerian oil and gas, right? We've seen marked improvements, right, in the loss factors, or reduction now, no improvements. Reduction in loss factors, pipeline evacuation in Nigeria. As I said, there was a time, right, under the old previous administration where we're seeing losses as high as 70, 80%. It was unbelievable. Towards the end of the last administration, there was a move to address that security issue, and it was sort of split into the west and the east of the Delta. As I indicated, the Delta is really massive, right? Mm-hmm. In that 6 to 9 months, we saw losses on the Focados, which is the Focados evacuation pipeline infrastructure, reduced from anywhere between 60 and 80% to 5-6%. We were in the east. We're part of the second phase. The data from the last evacuation reconciliation for May was 0 loss. So the excitement is actually difficult to contain how excited it's been for us, given that we've had to evacuate using tanker trucks and approval processes that are very, very tedious and drawn out. We have an opportunity to use the TMP. We're correctly connected to TMP, so all we need to do is just start sending the crude back down the pipeline, and we now are able to bring in the 2 new wells we're planned in the next 6-12 months and follow that with subsequent wells.
Well, thanks, Sammy, for taking us through the story. That's all the time we have. We need to get on to the next presenter, but thank you for taking us through the Declar story. Thanks for hanging around this afternoon. We're on to our last presentation from Trillion Energy. Trillion Energy, we're going back to Turkey with this story. Another Turkey gas development story. We have Arthur Halloran, President and CEO, to take us through what Trillion's doing, but the company's had a lot of success in their development. They've been putting out all their well results and consistently coming in as expected. And with that, the production ramp up has been quite nice. So with that, I'll hand it on to Arthur to take us through the Trillion story.
Thank you very much, Adam. It's great to be able to present here. So I'm Art Halloran, CEO of Trillion Energy. And like Adam said, we are an oil and gas producer in Turkey. And right now our main focus is offshore Turkey, about 8 kilometers, a large gas field or a number of gas fields called SCSB. And we're in the process of developing that project. And this picture here is one of our platforms. This one's called Akit. We trade on the CSE, Frankfurt, and the OTC. So the company highlights are we are 49% owner of this gas field. It's called SASB. The other 51% is owned by TPAO, the Turkish Petroleum Company, the government company. And we operate the drilling because we have the expertise for shallow water drilling. And we're in the process right now of a multi-well program, which we started with September, October. And right now on the field, we have probably about 300 BCF original gas in place. But this drilling program we're doing right now is just focusing on 100 BCF. And we have a large infrastructure in place that is already done that we got when we purchased the predecessor company in 2017. And Turkey, we have a high gas price and very good fiscal regime, 12.5% royalties, never changed. And we have a corp tax of 22%. Our shares, we have an excellent liquidity. And just a couple of days ago, actually last week, 33 million shares traded in one day, and we average probably about 4 to 5 million shares trading a day. So the overview of Turkey is part of Europe. It's part of NATO, as you know. It's a very large populated country, and they really are focused on gas as their transitional fuel. They import 98% of their gas. They're the 7th largest natural gas consumer in the world, and 60% of that gas that they import comes from Russia and Iran. We're in a high gas price environment currently right now, and for the last 4 months, it's been about $14 US an MCF. And how it works, there's a company, that's a government company called OTAS. At the beginning of every month, they import into the country volume of natural gas, and they set the price, and we get the same price as what importers get for their gas, even though we're domestic. And what it does, it kind of mutes the price increases and decreases, so it's more stable, and we don't get the wild fluctuations. And as everybody knows, right now the gas in Europe has increased, and we're still at the $14, whereas when it was below, we still stayed at 14, so it kind of levels it out. So as I mentioned, our property, SASB, is in the Black Sea, and it's about 12 kilometers. And the Black Sea right now is starting to develop and become a potential natural gas supplier for Europe. And there's some fairly big discoveries in like Romania, Bulgaria, Romania, and these discoveries we're talking in the order of TCF and also hundreds of BCF. And recently, not so recently now, but within the last year or so, the TPAO, the Turkish Petroleum Company, did a big discovery of about 10 to 23 TCF, about 100 miles north of our field, SASB. And what that has done is that before in our area, we thought, or we didn't think, but the thinking was there wasn't enough gas generated to charge larger structures. So there was a conscious effort to chase the smaller structures. But with this large discovery, it illustrates, there was the proper oven was going on, and the evolution of the basin, that there was a lot of gas generated to fill the larger structures. So now we drill down into our SSB. So in Turkey, we also have an oil field that is a long-term, low decline oil field. It's basically water recycling with an oil cut, like a lot of Canadian type oil fields. And we might produce for a full year 40,000 or 50,000. That's our interest. We only have about 19%. But by the end of the year, there's usually a technical write-up, and we have recouped those reserves. So the decline is, at this point in time, is very low. For the SASB, we have third-party engineering reports. We have NI 51-101 compliant end-of-year reserve reports, and also an update in January. And we also have a third-party resource report, and that gives us a different levels of reserves and resources. But SASB has a lot of gas, and right now the original oil and gas of the reports is over 300 BCF, and I'll have to say that to add a resource and a reserve is not really under the NI 51 regulations and so on, but it gives you an idea of what there is, because there are different category reserves and resources. For the reserves, our update of January 2023, and this is again NI 51-101 compliant. We have a P2 reserve of 63 BCF. That's our 49%. And that increased from 20 BCF from when we started the project in December 2021. And the pricing was about half a billion US dollars. And of course, with the pricing, it goes up and down. Since we started this project, September, October, we now have 5 gas wells that we have drilled, and actually 4 gas wells we drilled and 1 we completed. And on top of this, we have a bunch of resources through extensional type and development drilling for the reserve projects, and also some exploration. This is SASB field. You can see the shoreline. One of our competitive advantages is that we actually have existing infrastructure, which was probably to replace it would be about $600 million US. And it's an onshore facility, gas gathering pipelines, and 4 platforms. And if you look at this, you can see the platforms there. They were over 4 gas fields that were discovered and drilled and put on production, and they produced it's about 42 BCF now. But additional to those 4 gas fields that were put on production, there were 4 more gas fields that were put on production, and 4 more gas fields that were discovered but never put on production. Can you put one more slide here so I can get the overlay on it? So the whole project that we're doing right now is we are just directionally drilling from the platforms to tag into the fields that were discovered, and that means drilled, tested, mapped, but never put on production. And so since then we have drilled since September, October, we've drilled South Akit 2 well, which you can see the first platform below that. And that actually was a exploration location. It was not a development. We also then recomplete Akit 3, and you can see what these wells tested at, 7 to 8 to 16, 19 million cubic feet per day. They were put on a 3 to 4 million cubic feet per day production for the average type well, and they were choked back, and I'll explain that shortly. And the other wells like Gulich was put on at 8 to 9 million cubic feet per day. But what we have now is West Akit, which also was an exploration, Gulich 2, which was an exploration. We have just finished Bahanli 2, and that's the one that we put on here June 1st. And so that's been on an average of 8 million cubic feet per day. And the only thing that we are now finding is that we are getting more gas than we anticipated. So some of the wells are producing extremely high, and they're backing out some of the production of other wells. But that's just a short-term issue to work at. Over a long term, all the gas will be produced. And what we've done now is we now have spudded Ali Pili 2, and we're probably at about 600, 800 meters right now. And so the whole concept is to piggyback on the existing infrastructure, and that's our competitive advantage, and directionally drill out from the platforms to the known discoveries. And now with the exploration, we can have follow-up locations. And I'll say it's not an issue to have locations because there's a lot of gas here. The issues are engineering and financing. And so we already have the onshore facility, which is rated for 75 million cubic feet per day, but we can up it to 150. But we'll never get to that point. This is just a quick figure of Akit field. So the red Akit in the middle, that's the well that we have recompleted, but that's where the platform is. So we directionally drilled in the long reach wells, South Akit, Gulich, and West Akit, and it allows us to drill and put these on way cheaper and faster. So we drill the wells, we test them, and we actually test within the facilities. And within 1 day, they're on production, and we're starting to get sales revenue. And whatever we produce in the month, we get the check the 20th of the following month. And also, it's easier to work over in the future. And so right now, we are reperforating West Akit and Akit 3, because those are the 2 wells that had some production backed out by Gulich. So the concept is to perforate larger intervals and bring more production on. This is just a quick slide on South Akit, and then you can see the old wells and then the new wells that we've drilled. All I want to show here is that we have numerous stacked pays. So it can be from 75 to 35 meters of gas pay in stacked sands, which again, for mitigating risk is very good. But we already know what's going to be here because these wells have these pools have either been drilled or part of a pool that has been drilled. What I want to show here is that we're right now in the process of understanding how to maximize the production of the field, because now we have 5 wells, and now we're drilling 6, and then there'd be 7, and so on. And we need to, we have the gas, we discovered the gas, and now it's to maximize the production. So South Akachoka was our first well, and we perforated about 22 meters of pay, and it was choked back. So it could have gone on production probably about 4 to 5 or 6 million cubic feet per day, but they kept the choke down because they were unsure of the behavior of the gathering system and so on, because in the old production was at 500 MCF, that's 1,000 feet per day, and we're now in the order of 14, 15 million cubic feet per day. And so the idea is to get the field where you find the low pressure sinks. But all this slide illustrates is, first of all, it's a new well, and we're bringing new gas on, but it shows you that the initial production was choked back, and then as they opened up the choke, and this is an example of a well that we perforated about 22, 24 meters of pay, and then you get a long production decline, and then it'll level off and it'll produce level, not really level, but with a very low decline for a while. And when it gets to a certain production per day, we'll go back in and perforate additional zones. And this has been on since November. This is Gulich. This was what we call the monster because it was at a higher pressure. And when it came on, it was on at 9 to 8 million cubic feet per day, but we only perforated 5 meters. So it had 75 meters of pay, and we perforated 9 meters. This well came in on at March, but we get a horrendous amount of flush production. And then you can see the decline rate, and it'll go down. And at the very end here, just last week and so on, again, there was a change in choke, and the production is back up. But you'd get to a certain level, and then you would go back in and reperforate another 4 or 5 meters, and or we're leaning out towards a larger perf intervals, and then the production will go back up. And that's what we got to do is as we get the fields develop with more wells, it will be going back into each well every 6, 8, maybe 12 months to perforate a new zone. The production profile will go back up to like an original because it will be an unproduced gas zone. So if the well or pool produced, we put it on say 8 million cubic feet per day, the assumption can be is that it'll be slightly higher up in stratigraphic interval, but if we perforated, it'd be up probably to 6 million cubic feet per day production. And you know, that kind of production profile. So it'd be just like a new small well each time. What I want to show here is that I've been talking about the structural prospects, the ones that we have a reserve report or resource report. As everybody knows, we're getting the seismic reprocessed. It's a 3D seismic. It has AVO anomalies. We had some work done initially on the data, and that work should be done here by middle of fall, and we'll be picking locations. So the end of December, we'll have locations picked. But we went back at the old data, and the geophysicists recalculated some of the algorithms. And what has happened is that you can see the existing structural fields. So it's Escadale, Akachoka, Gulich, but the round circles are indicating stratigraphic exploration, AVO anomalies that would be new pools that are not connected. These pools would produce the same as the structural ones. They would take less wells because they would not be broken up. It's like on-lapping sands. Again, it's stacked sand, same stratigraphic level, same source rock. It's just that none of these have ever been drilled. So they are a total new prospect, and therefore they can't be given a reserve or something, and they're classified as exploration. And there's a lot of them. You can see that some of them are the same size of the known structural pools. Because we're dealing with a fixed stratigraphic section of you know, a couple of 100, 300, 400 meters, you can get slices. Here's another slice. of the stratigraphic interval, again with the seismic AVO anomaly, which from experience actually identifies or sees gas saturated sand. And basically red means good. And here you can even see a meandering channel. The white circles are the fields that were discovered and were producing and so on. And the red is indicating high probability of gas. So what this shows you is that there's way more gas here than even I thought there could be. So that is on the block. We have the structural old known pools, the reserves that we're drilling, exploration and development of the structural pools. We also have the stratigraphic pools now, exploration on SASB. And like I always mentioned, it doesn't end at the edge of the block. It's got to carry on. It's showing you that there's a lot of gas generated here. There are reservoir rocks, there are traps, and we know there's larger structures, and now we can look for onlapping. We used to own all the red, and the little blue is our block for SASB, and the southern red line is the shoreline. The northern red line is, after that, you have to partner with TPAO, and you can see to the north that that's the 19 TCF discovery. We have the 3D seismic, we have all the geology and the modeling. And so I've said this many times, but we're in the process now of identifying off SAS block gas deposits, which would be in the order of 300 to 400 BCF and potentially a TCF, but it is exploration. So we know a lot of gas is generated, but I have to say it's exploration. But also now with our success that we're having, there's a lot of chatter about us because we went from 500 MCF, that's 1,000 cubic feet per day, to in the order of, right now we're at 14 million cubic feet, and that's because we turned off Akachoka 3 and West Akachoka because we're completing those. When those two come back on, they should be in the order of at least 3, and that's a conservative number, and that would be a 20 million cubic feet per day, and we're continuing to drill. So we are now we are the largest independent gas producer in Turkey, and there's a lot of chatter about our success because of the technical difficulty of the wells, that we are getting across our table a lot of exploration and development projects in Turkey. So we are looking in Turkey for not just SASB type, but other types of projects. Yeah, so a quick summary is natural gas project in an area where gas is needed. It's Europe. We have a huge inventory of gas projects, gas wells to drill. We are successful 5 for 5 so far, and we are targeting 100 BCF, and that's a plus because there's a lot more, as you can see, and we are a success story.
So let's hop into some of this Q&A here. Quite a few things coming in through the chat. So first one, is the approximately 14 million cubic feet a day flow rate total? So your portion would be about 7 million cubic feet a day?
That's correct. Right now, that would be total. And a large part of that is because, like I say, they still choke back the wells.
Three-part question here, or 3 questions from one interested party. One, could you provide more details around the re-perforation of the first well to increase its production, or their first wells to increase their production? How many wells are going to be re-perforated, and when? What the increased flow rate can be expected, and what's the timeline for this?
Okay, so we're recompleting West Akachoka right now, and also Akachoka 3. And the reason why, like I said, is that with Gulich, we had it was a high pressure well, really kicked out, that it backed out the pressure. So we are recompleting there right now. So Akachoka 3, we're going to complete probably 15 or so meters, mainly the remaining pay in Akachoka 3, because that's an old well. West Akachoka, we're going again at probably a 4 or 5 meter, 7 meter interval. The new perf intervals will produce like a new well. So it's because they're separated, they're not in communication. So it's like a new reservoir. So like I said, if the old well was, even if it was I can use a choke number, put on production at 4 million cubic feet per day, and that was choked back, as you saw with the production decline. The new perf interval would be roughly the same. And so it's also an ongoing project. So because this is a conventional reserve, a conventional reservoir, it produces a lot of flush production. And so we get good cash flow, and then the production declines like you saw. So when we get down to probably about 1 million cubic feet per day, we'll go back in and perforate another zone, and then we're back to the normal. And we'll do that over the 6 to 10 year life of the reservoir. And it's probably depending on the well, between 6 to 12 months, we'll go back in and reperf those. And it's very inexpensive because it's a wire line that's on the platform. So it's about $200,000 for a reperf job. So we don't need the rig.
Second part of that question stream was, could you please provide more details on the stratigraphic targets in the SASB block? Will they be perforated once the 3D processing is done, around 3 months, or when? How big are they, and what would their approximate expected flow rate be?
So the stratigraphic right now are at exploration. So what it is we have the structural, and we can see in the seismic the AVO anomaly. We drilled it, and we know that this certain signature is definitely gas. So for the stratigraphic, none have been drilled yet. All we see is that in the old seismic, and as you see with the new stuff that we've done, is that we can see the same AVO anomaly, and they are stacked. They're at the same stratigraphic level, but they're at the flank of the structure, so they're at a deeper depth. So they'll be at a higher pressure. They probably will produce at a higher rate and have more gas volume per area, but they will be predominantly similar to the structural wells that we are drilling. The assumption is, and it's not known until we drill it, is that because they're onlapping, what I mean is they're blanket sand stacked, and they're not related to a large nose structural. They're not going to be broken up, and a single well will produce and recover more gas in a stratigraphic trap than in a structural one.
Okay, and the last question, last question from this participant, comments on off-block acquisition time and size of targets.
So off-block, there's two types now. One is following the SSB type, off our block, and that is just in the process of working out the work program and then coming up with the bid, which is the work program, and you put a bond, which is actually 2% of your work program, and we already have those sitting in our shelves. We know which one we want. We just would like to wait until we see some of the reprocessing of the seismic. So we'll start seeing some of that in early fall, because the actual reprocessing will be finished in September. And because on these blocks, you're talking work programs of like 100 million. So it's better to make sure you have better data. So hopefully we will be towards winter and so on applying for the blocks. Onshore, we don't have that issue. Onshore, the wells take $2.5 million to drill, not 12 to 13 million. And we've already have looked at some blocks and are well on the way, and we're hoping to have some around the end of summer start applying for some of these.
All righty. I know we're right at 2 p.m., 2 p.m. Mountain Time, but there's two more questions, so I'll just quickly ask them. When do you anticipate bringing the two wells back online and getting over to 20 million cubic feet a day?
Those two wells, so West Akachoka should actually be on production here within the next day or two, and then they'll just move over to Akachoka 3 and do that. So both wells should be done within a week or so, and so that's when the production would be up to added to the 14. And that's the thing, is that the 14 million now is not including those two wells. It's only 3 wells at the moment.
Great. Last question. How does the company feel about regulatory, taxation, royalty, environment, stability of Turkey now that the election is concluded with Erdogan remaining in power?
Business as usual, nothing has changed. So we feel very comfortable.
Perfect. Well, great story, Art. You guys have had a lot of success with your development program. We look forward to seeing more. I'd like to thank all our panelists and all our participants for their time this afternoon. We dug into 6 stories on the international side, all very interesting development and exploration opportunities within that suite of investment options. So with that, I think we'll wrap it up here today. Thanks everyone for your time today, and we look forward to hearing lots of good news from these stories in the near future. Have a good one.